Hi, everyone. Welcome to Real Estate Real News. My name is Mark Weithorn. I'm with DPI Websites. My company has been creating websites for realtors for about 20 years now. We also are I'm also a national speaker. I mostly teach classes at the Miami Association of Realtors. I've been doing this for about 20 years, and plus at a whole host of other real estate boards or conferences. So this is a podcast about the real estate industry. There's a lot of moving parts that are going on. And basically, I want to try and keep you up to date as to all the different statistics and trends and things that are going to help you understand the real estate industry, and also whether you should be investing or you should be sitting on the sideline or you should be buying or selling. There's always good statistics. The real estate industry is really well known for a lot of their statistics. So let's first start with something that I call vital statistics. Sounds very medical. So here's some charts that I have. I'm located in South Florida, Miami Beach, Florida. Yay, Miami Beach. And the Florida Association of Realtors has a lot of really good statistics. There's also good statistics from the National Association of Realtors, but the Florida Association of Realtors really, spells it out for you. It's really cool. So first of all, let's look at single family home sales in South Florida. Southeast Florida, technically, if you want to talk about it. Miami, Fort Lauderdale, and West Palm Beach counties are the MSA Metropolitan Statistical Centers for Southeast Florida. And if you look at the number of sales in South Florida for single-family homes, it's doing well. It's consistent. It hit a peak in March, but it's doing well. And then if you look at condos, condos are interesting. Single family homes, the inventory levels, have been dropping like crazy. It's a result of COVID. I mean, COVID's changed our lives. And one of the things that it's changed is the way that people buy and sell real estate or where they live. Now that people can work remotely, basically, they can live anywhere. I have one of my nephews, he lives in New Jersey, but his employer is in Washington, D.C., and he has never been to their office. I mean, he had another job and they offered him this one, and he accepted it. He may have gone on an interview there, but he never goes to the office. He has a little office in his house, and that's it. So he and his wife and their young daughter, they purchased a house in the suburbs in New Jersey, and they are just one of the many people. They're millennials. They're just one of the people who have been purchasing and purchasing and purchasing and driving the inventory levels of single family homes way down. I read another article, which is really interesting, about baby boomers. Baby boomers are starting to retire, and they're not necessarily, some of them are staying in place. They're not selling their homes because, property values are down. And not property values, income tax levels, property tax levels are down. And, they stay where they are, but some of them actually are purchasing homes near their children because they want to see their grandkids. So they're sort of competing with the millennials for the single family homes. It's really interesting. So inventory levels of single family homes is way down. But condos, the inventory levels, especially in South Florida, were really high. Here, let's look at inventory levels here. This is something called months supply. So in 2008, months supply of single family homes were off the charts. I mean, that was after the Great Recession, when the market crashed and all that. And then with COVID, the inventory levels of single family homes, they dropped. But condos are interesting. In 2008, condo levels, were what's for sale was off the charts. It was really high. And then a lot of cash investors came in and bought all these condos. I remember one builder in South Florida. He put together with a bunch of other people, I think like $1 billion to go buy distressed condos. It was incredible what he did. That's why they say only the rich get richer. And then condo levels, they decreased in 2012, and then they started increasing again because they were low levels. So the developers started building again. And then we were sitting with like 3 years, 4 years supply of condos in South Florida. And then when people started buying again after COVID, because the single family home rates were so low, people were turning to condos. That's all that was available were condos. And now the inventory levels of condos have gone way down. So it's really an interesting market that we're in today. All right, the next thing I want to go over is retail sales. So, retail sales, they keep predicting that we are going to go into a recession. Retail sales and GDP and all that, and it shows a decrease month after month, I think 3 months in a row. Well, retail sales for June were up. There was a slight decrease in May, 0.1%, which is negligible. Basically, that's flat. But retail sales in June were up 1%. I mean, no one's gotten the memo that, hey, oh my God, the world is, is collapsing, the sky's falling and all that. And all of a sudden it's like, whoa, wait a minute. People are still spending money, and they're spending money like crazy. Another thing that I keep my eye on is gas prices. So, we were teetering with $5 a gallon for gasoline. By the way, to all those people in the news media who who report this, please stop showing gas prices in California, because they have like $9 million a gallon in taxes, state taxes. So, I mean, yeah, I could find gas for like, $4.50, but in California, it's like $6.50. So please stop being so sensationalism, just, show things that are more realistic. So what I've been keeping my eye on is the price per barrel. And the price per barrel for gasoline is below $100. It's like $95, which is typically where it's at. Unless we're in an extreme recession or COVID, it drops to like $60 a barrel. But typically, it's just right below $100 a barrel. So I'm going to be interested to see what the inflation numbers are, not for this month, because they're always a month behind, or last month, but I'm looking to see this month and the month after as gasoline prices are starting to drop. We were we did a little family trip for July 4th. We went to North Carolina to do some hiking. And first of all, the place was packed. People, tourists, the places were packed. There was one store, Mass General Store in Waynesville, and there was a 10-minute line to check out. I saw the face of the owner, and he was beaming, grinning from ear to ear. But basically, yeah, people are there. They're spending money. And we saw one gas station there where it was like $3.99 a gallon for gas. I was like, what? But mostly it was like $4.15. Then I came back to Miami and it was like $4.40 because, it is Miami. It's more expensive here. but retail sales are up. Another thing that I'm looking at is the value of the dollar compared to other countries. And here we have the dollar is now on par or parity with the euro. Now, this hasn't happened in a long time. The last time this happened was 2002 or 2003. And then all of a sudden, the euro shot up in 2008 to about $1.60. And then it's been bouncing all over the place. And then it's now dropped. So basically the dollar is pretty strong. It's like really strong. So if you look at the value of the dollar with other currencies, with Mexico in the last 6 months, the dollar has dropped about 2%. With Canada, about 3%. Now that's extremely relevant here in South Florida because we get a lot of Canadians who buy real estate in South Florida. With China, it's down about 6%. I guess that's good because we can buy more Chinese goods. But the Chinese gross domestic product or their growth was like really slim. Usually they're like 10, 20%. And I think it was like under 1%. And a lot of that has to do with their 0% COVID policy. So they lock down big cities like Shanghai. I mean, it's like, it's got to kill their production. South Korea versus the dollar, the South Korean currency is down about 11%. The euro about 12%, Great Britain about 13%, Japan about 18%. So the dollar is really, really strong. And what you find because of that, especially with the euro being on par, is, a lot of people are traveling. I was in Waynesville, it was packed. Oh my God. I mean, the half-hour waits just to get a table for pizza. Okay. It was nuts. And the pizza was okay. I'm a little partial to certain pizza places. Shout out to Steve's Pizza in Miami, North Miami to be exact. But yeah. So a lot of people are traveling to Europe. A lot of people traveling to Europe. I mean, basically, it's just the airfare. You typically don't rent a car in Europe. They have great mass transit. You take trains and buses and things like that. So what Heathrow Airport had to do, I don't know if any of you have traveled through Heathrow Airport, but it's like, it's crazy. It's a zoo. It's like a hodgepodge of like, take a tram from one terminal to another through all these back alleys of the airport. It's really crazy. They had to put a cap on the number of departing passengers until September. That's how nuts it is. I remember we were in Spain once and we were coming back from Spain and we had to change planes. Where else? Heathrow Airport. That's like the huge hub of Europe. So people are spending. I don't know if our GDP numbers will show foreign spending dollars, but it's going to be interesting. People are shifting from when COVID hit, we started buying items, material things, things we needed at home. Maybe you needed a new desk or a new printer or a computer. And then we started buying other things to make our comfort in the lockdown at home more comfortable. Now that we're open again and people are traveling. So I had one friend of mine who was complaining, oh my God, my Amazon stock went down. And I said, well, yeah, the economy is shifting. So basically we're going away from buying all these items back to buying, traveling and staying in hotels, going to Italy or going to Waynesville, North Carolina. So yeah, I'm going to keep my eye on this. All right, so let's look at some hot topics. Mortgage rates. So, mortgage rates are around the 5% range. And everyone's been freaking out. Oh my God, mortgage rates are at the 5% range. It's like crazy. What's going on? The world is ending, yada, yada, yada. Because, the government since like 2008 has really like kept everything really low. I mean, the government was doing everything they could. There was no inflation, and the government was just keeping everything low. I mean, the borrowing rate from the Fed was like just above 0%. And, people are all now freaked out because, the mortgage rates are basically, so high. So I did a little research and I looked at historic interest rates for mortgages. All right. In 2007, we were about 6.5% for mortgage rates. 2006 was the same. 2005, we were about 5.75% for mortgage rates. 2004, it varied. It went between 5.75 to 6.25. 2003 was about the same, mostly around 5.75. So historically, interest rates were always around, let's say, 5.75. But we've forgotten that because, the market crashed in 2008. The government came in and they started like lowering historic mortgage rates and interest rates and stuff like that. And now, as they say, the government took away the candy. So now we're going back to what's normal, which people don't remember what normal is. So there's a little debate that's going on about mortgage rates, and then also the levels of inventory for real estate. And what some people are saying is that the higher mortgage rates will basically slow down sales. So, is the cup half empty or half full? So, some people go, oh my God, mortgage rates, it's going to slow down sales, yada, yada, yada. But then the other hand I'm looking at is that inventory levels in real estate are so low because mortgage rates were so low that basically, that is also bad for the economy, having these low interest rates. So if you look at the inventory levels here of single family homes, you're going to see that it has been dropping and dropping and dropping. Now, in real estate, we have something called months supply. Months supply is a term we use in real estate to measure real estate inventory levels. Now, there's two markets. There's a seller's market and there's a buyer's market. The middle is 6 months supply. What I mean by 6 months supply is that if you had listings in the multiple listing service, the MLS, and no new listings came in, it would take you 6 months to sell out everything you have. That's 6 months supply. So 6 months supply is the middle. Less than 6 months supply is a seller's market. Too little inventory. And that's where we're at now. We're at with single family homes, 1.8 month supply. Condos in South Florida, 1.8 month supply. We are in a huge seller's market, very low inventory, bidding wars. People write love letters to sellers. Please sell me your house, things like that. More than 6 months supply is a buyer's market, too much inventory. Then you can go in and negotiate. You can, say, oh, no, this is overpriced. I want $50,000 off. So right now with single family homes, we're at 1.8 months supply. And with condos, we're same thing, about 1.8 months supply. And this is extremely low. This is dangerously low. I have some realtors, clients, who now all of a sudden, they can't make a living because they, there's nothing to sell. Basically, the store shelves are empty. There's nothing available. So, good realtors, I always equate being a realtor to playing baseball. There's there's offense and defense in baseball. You get up at bat and you got to be able to, hit the ball. Or defense, you're in the field, you got to be able to catch and throw the ball. It's the same thing with real estate. Being a realtor, you have to be able to succeed in either a seller's market or a buyer's market. You have to know what to do depending on the market. And you have to shift and change your strategies based on what the market is. So right now we're in a seller's market with low inventory. And the good realtors, the strong realtors, they're going after listings. They're spending money on marketing. They're going and they're sending letters. I get letters and phone calls and people knocking on my door constantly. My wife and I, we've been living in this house for over 30 years. So we're prime targets. Don't you want to sell? Don't you want to move? Well, there's nowhere to go. Sorry, not going anywhere. Nowhere to move to. And the rookie realtors, basically, they don't know how to succeed. They don't invest money in marketing. They don't invest money in their business, which is being a realtor. So you have some of these realtors who have fallen by the wayside. Now, typically the ones that are falling by the wayside, they're part-time realtors. Some realtors do it because they'll do 2 sales a year, and they'll bring in to the house an extra $15,000, $20,000, and that's great. It pays for summer camp or braces or things like that, and they're happy. But now all of a sudden, they can't even bring that in, and then they look at the cost of maintaining their license. Mostly, joining real estate boards, that can cost you like $700-800 a year. And basically, a lot of them are saying, you know what, it's not working out. I'm just going to hang it up. All right. So once again, they're talking about a rise in interest rates should balance the market. Now, I did a little video on this, a training video on this, and basically, you need a balance in the marketplace. Things need to be in equilibrium. If they're one way or the other to the extreme, it affects the entire economy in the United States. Real estate is one of the largest economies or factors in the economy in the United States. Just think of this. You go and you buy a house. What's one of the first places you go to? Home Depot. You go there and you're buying screws and tools and shelves and whatnots because you need to start, fixing your place up. And then you're going to hire someone to redo the kitchen, the bathrooms. You're going to buy furniture or flooring. You got a tile guy to come in. And this has a ripple effect all the way through the economy. Now, all of a sudden, you're not only buying the house, but you're buying materials for the house. You're hiring laborers to go and do things. So when we have 1.8 months supply of inventory, and we can't sell a lot of real estate because there's nothing to sell, that is bad for the overall economy. So is the higher interest rate technically bad for the buyer? Yes, it's going to cost them more money, but in the bigger picture, having such low interest rates and low inventory is really bad for the economy at whole. All right. So I saw another article, which was really interesting, which is more sellers are dropping their prices as the market cools. What was happening when the interest rates were so low and pandemic hit and all these millennials wanted homes is you had bidding wars. A house would go on the market and then the seller would end up getting like 10 offers, and then they end up selling a house for, I don't know, $50,000 more than they put it on the market for. It was crazy. Now, all of a sudden, because the interest rates have gone up, it has really changed things. Number one in the country is Boise, Idaho. 2 out of 3 sellers dropped their asking price in June. Number 9 is Tampa. 44.5% lowered their price. By the way, this is a study that Redfin did. If you look at some of the other areas, let's see, Tampa is at 44%, Cape Coral, 41% of the sellers have dropped their price, Jacksonville, 40%, Lakeland, Florida, 36%, Orlando, 34%, West Palm Beach, 26%, Fort Lauderdale, 21%, Miami, almost 20% have dropped their prices. According to the study of June home listings by Redfin, the number of sellers lowering their asking price spiked notably higher in June 2022 compared to June 2021. In the 8 Florida metros included, the range ran from 44.5% in Tampa down to 20% in Miami. So basically, people are starting to adjust. We're not in this frenzy anymore. Boise, Idaho led the first percentage of home price cuts, with nearly 2/3 of its listing prices reduced. The highest share of the 97 metros in the analysis. Next came Denver at 55%, Salt Lake City at 51%, Tacoma, Washington, 49%, Grand Rapids, Michigan, 49%, Sacramento, 48%, Seattle, 46%, Portland, 45%, Tampa, 45%, Indianapolis, 44%. That's the top 10. So people are starting to reduce the price of their homes. Sellers are adjusting their expectations in real time as they realize they may not get the price that their neighbors got 2 months ago. If demand plateaus in the coming months, price cuts are likely to be less common as sellers realize the market has shifted and they'll price their homes more realistically from the start. So, this is pretty interesting. We're starting to see where the market is stabilizing. I'm hoping that the inventory levels go up to about 5 months supply. I think that would be nice. But 1.8 months supply is just really unhealthy for the economy. There's nothing to sell. We're back, it's like I showed you, empty store shelves. All right, let's go into some more news. I read lots of articles every day. I mean, this is so much press on real estate. So let's go into more news. Here's the headline. Good renters may qualify for mortgages All right, on July 10th, renters who pay on time can get a home buying boost, even if they have thin credit scores. A big benefit for first-time buyers in undeserved communities. For years, many renters have struggled to qualify for a loan simply because their credit files didn't have enough established credit. Now that's about to change, creating homeownership opportunities for millions of first-time home buyers, especially in underserved communities. Starting on July 10th, Freddie Mac will consider on-time rent payments as part of its loan product advisors, LPAs, automated loan decisioning systems. So basically, this is going to be great for renters who have marginal credit scores. If you show that you basically have been paying your rent, then it will be counted towards, you know, the possibility of getting a loan or a mortgage. It's a fairly big deal because renters aren't credited by the credit agencies, said Guy Cicala, CEO and publisher of Inside Mortgage Finance. It's a huge hole in the credit scoring system. First-time buyers with little or no credit often paid sky-high rent, then were coached by mortgage loan originators to borrow, then pay off consumer loans to generate acceptable FICO scores. That's crazy, absolutely crazy. Mortgage people were telling people, oh, you don't have enough credit history, go borrow some money and pay it back. What, are you nuts? That is the stupidest thing I ever heard. Basically, you know, first of all, if you have not much credit history, you're going to pay through the nose in interest rates for loans. So that is really hurting, you know, the underserved communities. How does this work? Applicants must first-time buyers must be a first-time buyer within 12 months rent history. With the borrower's permission, a mortgage broker or mortgage lender submits the borrower's bank account data to the LPA to identify 12 months of on-time rent payments to determine eligibility. If you are unbanked and you pay the landlord in cash to pay with a money order, Freddie Mac allows lenders to manually underwrite loan files through verification or rent or VOR with the landlord. Whether you can find a mortgage lender to manually underwrite is another question. So this is a good thing for first-time home buyers, where they're starting to basically allow you to show that you pay rent. That's great. Good news. Most credit scores stop counting medical debt. So this is another item that they're taking off of the credit scores, medical debt. Starting July 1, the 3 US major credit reporting companies stopped counting paid medical debts on the reports that banks, potential landlords, and others use to judge creditworthiness. The companies will also start giving people a year to resolve delinquent medical debt that has been sent to the collection before it's being reported, up to 6 months previously. Next year, the companies will also stop counting unpaid medical debt under $500. The companies say these moves will wipe out nearly 70% of the medical debt listed on consumer credit reports. So this is really going to help people who are uninsured, people who basically, to get medical treatments, they don't go to a doctor, they go to the emergency room. Obamacare was targeted to eliminate a lot of this, where, you know, people start getting health insurance to cover a lot of these costs. So without insurance, if you get sick, you go to the emergency room, which is the most expensive method of health care. The Federal Consumer Protection Bureau has said its research shows mortgages and credit scores are better predictors than medical bills of whether someone will repay a debt. The agency, which monitors banks, lenders, and other financial institutions, has noted that people often don't have time to shop for the best price when they seek care and may have little control over the progress of their serious illness. All right, so that is a good thing. I'm hoping that that will help people in the who are less affluent or less or poorer than most to be able to afford to buying a house. It's reported that of the 58% of the debt and collections on credit records for medical bills, past due medical bills, is more prevalent among Black and Hispanic people. So yeah, hopefully that will help. All right, next, ARMs, adjustable rate mortgages. They're back. Stay tuned, they're back. Okay. Zero down interest only adjustable rate mortgages played a role in the last recession, but today's options are safe if buyers understand the pros and cons. A fixed rate mortgage, FRM, holds the same interest rate for the life of the loan. An adjustable rate mortgage generally offers a fixed rate for a limited period of time, often 5 to 7 years. After that, the ARM's interest rate and corresponding homeowner monthly payment can rise or fall depending on the market. The benefit of an ARM: the buyer gets a low interest rate. Lenders offer a low interest rate because the borrower has given them permission to increase their future interest rate. However, rates could also go down since any interest rate prediction 3, 5, or 7 months in the future has an inherent risk for the buyer. So this is pretty interesting. This is something that caused the Great Recession. Basically, there were a lot of, no income verification loans and adjustable loans, and then all these loans came due. This is about 2008. I remember watching the movie The Great Short. That was a great movie. I loved it. It was a really good movie. It really, in a comical way, explained what happened. I mean, it was funny, but it was it was sad, the reality. I remember some Wall Street guys were doing some research in the suburb in, I think, West Florida, and this is in the movie. And they knock on one guy's door, and we're looking for Toby. I don't remember the name, but I'm making up Toby. He's your landlord. And the guy who answers the door says, "Why is my landlord's dog the owner of the house?" That was hysterical. So yeah, the ARMs are back. And basically we have to keep an eye on this because it could cause problems. Common types of ARMs, according to the Department of Housing and Urban Development, a 3-year ARM may increase by 1 percentage point annually after the initial fixed rate period for those 3 years, and a maximum of 5 percentage points over the life of the mortgage. Or you have a 5-year ARM may allow for increases of 1% annually and 5 percentage points over the life of the mortgage, or may allow increases of 2% points annually and 6% over the life of the mortgage. And a 7 and 10-year ARM may only increase by 2 percentage points annually after the initial fixed interest rate period, a 6% points over the life of the mortgage. Some of the things that they use to some of the components for ARMs, you basically have the index, the margin, interest rate cap structure, and initial rate. When the initial interest rate period expires, a new interest rate is calculated by adding a margin to the index, such as 2 percentage points above a specific rate, financial rate published in the Wall Street Journal. For example, the federal FHA loans may use indexes such as the Constant Maturity Treasury CMT Index. It's a weekly average yield of US Treasury securities adjusted to a constant maturity of 1 year. The 1-year London Interbank offered rate LIBOR. The interest rate caps provide some protection for buyers if the market sees large rates. There are 2 types of caps, 1 annual and 2 life of the loan. 1 annual cap, this restricts the amount of interest rate can change up or down in any given year. If the annual cap is 2%, for example, and US interest rates have risen by 4% since the last adjustment, the homeowner's rate can't be raised by the full 4%. Then you have the life of the loan cap. This limits the maximum and minimum interest rate of a homeowner will be expected to pay as long as they have the mortgage. If the life of the loan cap is 5% and interest rates 20 years down the road have gone up 10%, God forbid, since they took out the loan, for example, their increase is still limited to 5%. So yeah, this is going to be interesting about the ARMs. We also have to look at other things that mortgage brokers might be doing, no income verifications or zero down or things like that. We have to make sure we don't end up back where we were in 2008. Yeah, pretty interesting. On that note, let's talk about foreclosures. Okay. So basically, we're closing in on pre-pandemic normal. You know, we forgot what normal was. All right. I mean, we just, you know, we forgot, you know, first the market crashed in 2008 and the government came in and started readjusting things. And then COVID hit and we forgot what normal is. What is normal? I mean, we have a very short memory. And then there's some people, especially millennials, where when, you know, like the market crash in 2008, you know, they were still in school. They maybe weren't paying attention. Maybe they were more into, you know, going out and, you know, having a good time than worrying about mortgage rates and inventory levels and things like that. So in 2008, there were 1,333,000 foreclosures. 2009, it went up to 1.5 million. It skyrocketed in 2010 to 1.6 million. And then it started coming down after that. 2011 was 1.1 million. 2012 was a little over 1 million. And then in 2020, we had 165,000 foreclosures. And then COVID hit and everyone was like, oh my God, the foreclosures are going to go through the roof. I remember reading articles, oh yeah, foreclosures are coming back. Yeah, they are. Well, they didn't. The government stepped in as they should. And basically they helped people from being foreclosed on while we were in such a bad environment with losing jobs and whatnot. So like I said, in 2020, let's go to 2019. There were about 297,000 foreclosures, which I'm going to call pre-pandemic 2019. So 297,000 foreclosures. And then in 2021, there was 65,000 foreclosures, which is about a quarter of what it was in 2019. So now for the first half of this year, we're at 164,000 foreclosures. So that puts us just over 300,000, 320,000 foreclosures, which is pretty much in line with pre-pandemic numbers. So hopefully we're going back to normalcy. We'll see. All right. So in the next podcast that we're going to do, I'm going to be looking at what I call, this is my future cast. This is what I keep my eyes on every day. We're going to look at closed sales levels. I want to see, are things still selling, and the rates that are selling at, how many people are reducing their prices. I'm wanting to look at month supply. Like I said, we're in single family homes and condos, we're under 2 months supply. I'd like it to get back to 5 months supply. That's more healthy for the economy at large. Mortgage rates. So we have to see where that goes. I'm not sure if the Fed is going to increase interest rates or not, and that will affect mortgage rates. Right now, we're a little over 5%. Remember, normal is around 5.75% to 6.25%. So we're still a little bit lower than normal. But we have to see what the Fed does, because, consumer spending is up and unemployment is down. Oh my God, the world is ending. But, inflation is high. We're going to look at inflation numbers. The inflation numbers for June, I believe, were higher than they really are because of fuel costs. I think now that gasoline is down below $100 a barrel, where it should be, I think you're going to see fuel costs go down. So probably, if not the July numbers, but the August numbers will probably show inflation rates starting to subside. And I hope the Fed doesn't overreact until we start seeing those numbers. Plus, the roads are packed. We drove to North Carolina and the roads are packed. People are traveling and going places because they're tired of being locked up and they want to go and breathe fresh air. We're going to look at employment numbers. They've been solid for quite a while now. Consumer spending, we'll see if that continues to go. We'll see where the GDP numbers come in. They should be released shortly. And then the strength of the dollar, that has pluses and minuses. The pluses is we can buy more because our dollar has more strength, but it also stops people from like Europe for visiting the United States and things like that, because their dollar isn't worth as much. And in South Florida, we rely a lot on foreigners buying real estate, especially from South America or from Canada. And if their dollar, if their currency doesn't go as far because our dollar is strong, then basically it's, they're not going to buy as much real estate. All right, great. I think we've filled our brains with enough statistics and information today. Stay tuned for more podcasts. My name is Mark Weithorn. I'm with DPI Showcase Websites. We have been creating websites for realtors across the United States for close to 20 years now. These websites are linked to the MLS. And basically, it is a great tool that realtors need to have in order to show that they are for real and that they basically are a serious realtor. You can go to my website, dpishowcase.com, dpishowcase.com, where you will see different samples of what we do with the websites. Also on there is a page called Classes, where you could see some of my upcoming classes. And then also there's a link to my YouTube channel where I have tons of training videos for realtors. Some of them are my full-time classes, like hour-long classes, and other them are what I call my 2-minute tech tips. So dpishowcase.com. All right, thank you everyone for staying tuned. And if you feel free to contact me if you ever have any questions. Thank you.